And welcome back, everybody, to this week's episode of Corporate Underground. We've got Craig Scheef back again, and today we're going to talk about the psychology of investment. And who better than someone who has over $100 million in funds and invested, last year I think your fund went up 94%, 40% this year. So you're in a sweet spot, and we're happy to take some just about psychology of investment, not necessarily the kind of nitty gritty of which stocks to choose and all those things. So, Craig, welcome back to the show.
Thanks, guys, for having me back.
Now, part of today's show was to kind of talk about the psychology of investment. So, nuts and bolts, what does that mean to you, and what does that mean for the people watching?
Yeah, so my background's as a chartered accountant, and after I'd been doing that for 7 years, I moved across into investing for a funds management firm in Sydney.
And you left chartered accounting? Oh, man, the world, why? Why?
He had too much personality for it.
Yeah. You want to acquire a lifestyle of investing $100 million. Yeah, sorry, carry on.
So the group I joined were very good at fundamentally analysing businesses, and I learned how to do that over a number of years. But it was interesting. It was at a point in time, it was in the early 90s, and it was a point in time where the share market itself has character, and it didn't like small companies at that point in time to allocate money towards them. So we were finding all these really good businesses, but the share price wasn't going up. And so I started a bit of a trek thinking, hang on, there's more to investing than just finding a good business to put your money into. There's this overlaying factor that sits on top of it that values those businesses every second of every day, called the share market. And so I started a long journey to work out, okay, well, how does that work, and what's the psychology of investing, and why do people say one day, a business is worth 5 times its earnings, and another day they say it's worth 50 times that earnings? It can be a multiple of magnitude over the difference that somebody will use to value that business. And so it obviously comes down to how people think at that point in time something's worth. And I started this journey of looking at understanding that behavior. It's called behavioral finance, or some people call it technical investing, technical analysis, and it's a way to try and measure and track the psychology of people, and do that in a way that you can actually track and measure it to work out where you are in the investing cycle. But I guess basically the psychology is how people think at a particular point in time in terms of what something's worth, or where do I want to be investing, and the extremes are greed and fear.
So you work with what's the word for it? Non-moronic investors. I think that's the word you say.
Sophisticated investors.
That's the one.
With the top hat and the monocle.
Yeah, sophisticated investors. For those of us that aren't sophisticated, like where do we start? What would you recommend for those that aren't in that status?
Yeah, and having said that, sophisticated investors, from where we invest, is actually a definition by the ASIC, to say that if you've got a certain amount of money, then you're sophisticated. Some of our clients have never invested in the share market before, or have had little exposure to the share market before and don't fully understand. So it's an education. So just because you're called a sophisticated investor doesn't mean that you're sophisticated. So,
but before that, is there a reason for that? Is it because they want to keep people with money, the sort of saying you can lose some, or is it that they want to be able to give the access to this knowledge only to the wealthy? I mean, what is the thought process behind that?
The logic is, if you can either have earned $250,000 in each of the last 2 years, or have $2.5 million in assets, or can afford to give somebody $500,000, they're the criteria you need to be defined a sophisticated investor or a wholesale investor. I think ASIC think if you meet any of those criteria, then you have enough monetary resources behind you to go and pay an accountant, a financial advisor, or somebody to help you make the right decisions. If if you've got those resources, then you don't have that ability necessarily to do that. So it's really a protection mechanism.
Sounds like a PR risk analysis sort of thing, isn't it?
Yeah.
So there would clearly be a herd mentality. I'm just thinking of Matt's picture behind, the elephant herd mentality in the stock market, where people kind of get in, they're going to jump on a bandwagon, they get out at the wrong time. There'll be a huge amount of psychology in that. Is that kind of FOMO, greed, all of those things? Because you talk about the fact that often people, would spend $10,000 on a stock tip, and yet they'll do fewer research than they would to buy, a $500 washing machine. So is that sort of driven by fear and greed in that way?
Yeah. I think it's probably a lack of education in terms of how one needs to properly invest. And somebody will, cryptocurrency recently has been a perfect example. People just say, "Oh, my mate's making so much money, I need to buy some. Let me make some money." Whereas, as you said, if they were going to go and buy a washing machine, they'd probably spend at least a weekend going and searching and looking for it. So, at the end of the day, I guess it does come down to a greed element that, okay, I want to make some money and I'll do it the quickest way I can, rather than doing all the research behind it.
Well,
the guy that mentored me for 10 years had a really good saying, and he said, "Many have the will to win, but few have the will to prepare to win."
Well, Warren Buffett says, be greedy when others are fearful, and be fearful when others are greedy. So, and Charlie, I want to thank you for mentioning the elephant in the room. It's really important to me that we talk about these things. Look, if everyone is thinking alike, then someone isn't thinking. And that's usually a good way to look at something. I mean, I'm usually always trying to look at something opposite. I know that annoys you, Craig, and a few of our family members, but I'm always trying to take on a different, maybe everybody in the room, but to look at things differently when everybody's thinking the same. How do you see thinking along those lines? I mean, are you always looking for the difference, or are you quite happy is that where you find the gold, or is that just causing a problem?
It is how you find the gold, and there is a balance. So I think where you tend to make the most money is when you invest at the opposite of where the masses are thinking, that contrarian thinking. When we probably a good example, we probably did that when I first set this business up 15 years ago. We quite liked energy as a space. We could just see everyone consuming energy. The energy market was growing about 5% a year, and nobody in Australia was looking at uranium. Australia actually banned uranium mining, but we had a 3-mine policy, and we thought that was going to change. Nobody else was, not many other people were looking at that. And so we went and did a lot of research in uranium. We went and invested in that space, thinking that policy was about to change. And after that did occur over the next few years, a lot of those investments went up over 10 times in price as other people started to invest, and the valuation metrics blew out, and those shares did exceptionally well. But unless we were contrarian, went against the herd at that point in time, we could have got in along that journey. And sometimes you're safer to get in along that journey. And we've done that recently. Actually, we haven't invested in uranium since Fukushima. And we invested again recently. The shares had actually already run. I've been following it for many years, but just didn't know when the psychology would change to move back in. And so next time we actually waited for the investments to already go up, and then we bought as they pull back. So there was still a lot of uncertainty, but not complete uncertainty. I think your point's very, very valid, that being a contrarian, and particularly at tops of markets, where like in 2000 was a great example, and back when cryptocurrency, I don't know what it was, 18 months ago, was $60,000. Everybody, I went to a dinner party, and there was no finance people there, and they were all talking about how much money they made out of crypto. And I was thinking, geez, this has to be near the peak, because once everybody's talking about something, it means everybody's invested and there's very little new money to come in. And, over the following 12 months, the crypto went from 60,000 to 30,000. So yeah, it works at both sides. When everybody's feeling really confident and that now is a safe place to invest, you need to really start to be exercising those opposite thoughts.
But I remember back in '99, Amazon. Everybody was looking at Amazon and go, "They're a bookstore. Where is this going to go?" Like that. Come on. I mean, like they're just taking out books, and yet nobody saw the market. Or not many people saw the market change. But when they did, it started a whole process around. I mean, crypto isn't so much about Bitcoin, or it's about the process behind that, and about how people have felt ripped off with finance for so long, paying money to a bank and not getting transferring it quickly, or the ease. If you look at some of the stuff that's happening in China around how easy it is to transfer small amounts of money quickly, which is your money, to pay off other things, all of a sudden it's seamless. And if we're ever going to get to the internet compatibility of all things, then it's kind of have to have a different way than money. And the way that people are not using money, if you look at any of the areas that have broken, like taxis, people didn't like it. So they're just waiting for something else to replace it. Hotels, nobody really liked a hotel, so they've gone Airbnb. There's all these things where the market is not liking what's there and they're waiting for the next thing to come along. Bitcoin's one of those. I don't think the Bitcoin itself is going to be that much of a game changer, but the technology beneath it. So that's when market change happens. But how do you get into that psychology of actually always looking for the change? And is the timing wrong? How do you get the timing right, Craig? You can look and see these things, but it always seems to be when you get into it.
Yeah, the timing of the market. There's a lot of people say you can't time the market. I disagree with that. I think to some extent you can. For us, it's about going back and just studying history and seeing how the market behaved at certain points in times. How did it behave at the 2000 top? How did it behave at the 87 top? How did it behave at the 1929 top? How did it behave? And then actually going back and studying those various periods and how did it behave at extreme bottoms. There's a whole bunch of tools and measurements that you can actually use to identify when you're at one of those periods, when the masses are invested, when the masses are exiting because the fee levels have got so high. And so those tools or those factors that we use are ways to measure that, the number of people buying options in the market and money flowing in and out of certain funds. And there's a whole bunch of ways you can do that, but you can track and measure it. And because we all get caught up in it. I remember going through the GFC. I remember being up at 4 a.m. in the morning. I remember being worried about the funds we were managing. And I remember even just recently in the COVID, when the share market fell 30% in 6 weeks, the fastest fall in history, is trying not to get caught up in that. And so having some tools that you can tap into and go, actually, in March 2020, the fee levels that we're measuring are worse than they were in the 87 crash. They're worse than they were in the GFC lows. This is mass fear and panic. It can't get much worse than this, even though it looked like the world was going to get collapsed with the pandemic. For us, that's the point we go, okay, take away the emotion. This has happened before. People have panicked before. This is actually when you need to be buying. And within a matter of days, that is usually the panic low.
So I've heard recently, or not recently, but over the last few years, that things are cyclical in the year. So like in the 1920s, it was a booming and they're going to say, well, look, in the 2020s, we're going to get the same. Is that just spurious? Is that just like people talking for talking's sake, or is there actually some sort of process that we go through these cycles that are there set amounts of time, or is it
I hear that. Yeah, sorry, Matt, but I wanted to add to that. Yeah, just the market correction. I heard those words, like to add to that, the people saying market corrections and stuff like that.
But so you've got like 1920s, there was a boom, and then in the 1940s there was a war, and people are trying to make those sort of comparisons to the 1920s, and then the 1820s and the 1720s. Or is that just luck? Is that just people trying to put things together that aren't really there, or do markets actually move in these cycles?
Yeah, they definitely work in cycles, and I think there's a bit of a saying: if history doesn't repeat, it at least rhymes, and it does. We will repeat what's happened in the past again, and there's business cycles, economic cycles, share market cycles, interest rate cycles. We're at the bottom of interest rates now, and interest rates will start to trend back up. So there's fundamental reasons behind why these cycles work, and there's debt cycles, and we're obviously reaching a peak debt cycle at the moment with the huge amounts of stimulus that's been pumped in. So, and overlaying all that is this psychology of the market and how people think, and money coming into the market. And we're in a strong bull trend at the moment, and that's probably going to remain for some time longer, but it will end like all other bull cycles end, and interest rates will increase and inflation will return and the cycle will repeat. And what the families that I've noticed over the years that have built generational wealth are very good at managing that. They're very good at taking their money off the table at various points in time and sitting it in cash and waiting. They don't want to be in cash, when they can do well, but to have that cash at the opportune time when people are panicking is when you make that next generational growth. Or even for the average person, that's that step up when you can really move ahead in the world as far as looking after yourself.
So Craig, you're a poker player, so I can see the similarities. I used to deal poker, play poker. I can see the similarities, what you like about poker and investing as well. One of the things that is quite technical in poker is about resulting. You get a result, and then you automatically think you're good, even though your result might have been 20% chance of winning, 8% chance of losing. God, look at me, I'm a genius. I use these two crappy cards, and I lucked out on the river with my 1 in 30 chance of doing that. I'm a genius. That would happen obviously a lot in the stock market as well. People become used to the fact that these results are happening. They think it's all down to their skill, and in fact it's just the fact that they're resulting. They're applying the results, not the critical thinking behind why that stock's going up.
100% correct. And we've probably got a bit of that at the moment. And
am I 100 or am I 80%? Is there a bit of wiggle room there? Because
yeah,
focus on 100%.
No, you're totally right. I think, and I've got enough scars and bruises to show that over the time. I don't think I have a big ego, but at various points in time, particularly probably 20 odd years ago when we were in the tech boom, sort of think, oh, you can do anything. But the market's got a very good way of slapping you in the face whenever you think you know too much. So, I think it's being humble and having that process. And it's whether you're a card player, you're an investor, whatever, I think you need to have that to be successful over the longer term.
Craig, I've got we're closing up, so I've got a question, obviously, that's going to take it a lot longer to answer. But
I won't ask mine then.
No, you can ask yours. Facebook, Google, the amount of information we know about people, it's phenomenal. They can basically read when you get up in the morning to feed you ads, to do things. They're starting to read and analyze our behaviors and deliver things that we want before we even know we need them. Computers and AI are taking over. Is there a point when the synchronicity hits, when computers are actually as smart as humans, which isn't that far away, that you're not needed? I mean, the market will. We're talking about human psychology here, and humans are really crap at knowing our own psychology, but computers seem to be really good at reading it. Is there a point when the whole market can be rejigged or taken over, and lots of money made for people that are in the know, where other people are going to be left further and further behind?
I think there probably is. I think that will come. I mean, there's a lot of big hedge funds in the world that employ 50, 100 PhD people that all they do is look at the market from a mathematical point of view. And some of those have extraordinary track records. And some of those are completely blown up, like Long-Term Capital did 10, 20 years ago, and almost brought the whole world financial system undone because they leveraged themselves so much. But they had all those experts and worked a lot of those models. So people have tried it, people are still trying it, and some are succeeding. And yeah, I think it probably will get more and more along those, along that over time. But I don't think anybody's really mastered it en masse as yet.
Tony, your question.
Before I'm not going to do it. I'm going to do my nice one at the end. Let's get the Scheef top tips. All right. So this is a topic about psychology for investing. So give us your top 3 tips for where your head should be at before you throw money at something.
Top 3 tips for
well fed, well slept, and well eaten. And well sexed. There's 3 great tips. I'll be a lot more relaxed.
So, like we were talking about, like you don't want to jump on a get-rich scheme. So, like, what should you be doing? How should you be thinking before you throw money?
Look, I think trying to identify. There's a very famous US funds manager who had an incredible long-term track record called Peter Lynch. And I'd recommend anybody pick up his book. It's very easy to read. And he would come home and talk to his wife and say, and the wife would go, "Oh, I've just been to this great lingerie shop. It's got all the best this." So he'd then go and look at that lingerie shop and have a look at it and invest in it if the numbers stacked up. So there's a lot of common sense behind investing. It's a lot of, what you like, people started to get onto Zoom. Everyone started to use Zoom. If people invested in that early on, they would have done it incredibly well. So I think a lot of common sense is involved. Patience is involved.
That's you out, Matt.
It's called PR, man. It's called PR. If I'm the owner of Common Sense, and he mentions it, it comes back to me. It's hashtagged. It's all mine.
I meant the second one, patience. You got common sense. Is patience. That's where you lost it. Yeah. And the third one, Craig, to bring this home.
I think decisiveness and persistence. I think sometimes it takes a while. You need to keep at
which is it? Is it decisive? Is it decisive about persistence?
I can't make up my mind. Can you tell me which one I should choose? No. Really, what is it about being persistent? What is it? Tell me. Should I be decisive? I'm trying to find it out. Can you tell me? Come on. What's going on? I need persistence.
You set him up for that one, Craig.
Before you finish up with me, there's a really famous. There's some studies that have been done on the market where they've looked at over long periods of time. Why do people actually lose money, or why do people underperform? Even professional funds managers, they estimate up to 90% can't. Because
they're not investing with you, Craig. They're not investing with you. That's why.
The market over the longer term, and I think even investors in Warren Buffett. So Berkshire Hathaway, which has done incredibly well over a long period of time, they've found that people actually lost money investing in Berkshire Hathaway. How could you do that? And it's because of this psychology. When the market started to go up and there was a lot of greed and people saying, "Oh, we've got to buy more shares," they would be buying. And then the market would have a fall, it would fall 20%, and they'd go, "I'm getting worried," then it'd fall another 5 or 10%, and they'd say, "I'm out, I'm selling." And so even though the business or the share did incredibly well over a long period of time, they actually managed to pick the wrong points to be selling and the wrong points to be buying, so that overall they would do a lot worse than that investment. So I think that psychology of trying to think opposite to the masses, when you're picking up the papers and there's lots of fear and everyone's concerned, go and try and find a good business to buy. And when you're picking up the paper about all the money that people are making in the market, it's probably a good time to start to be cashing up and waiting for those more difficult times.
Awesome. Thanks, Craig. So that wraps up this episode of Corporate Underground, all about the psychology of investing. So thanks, Craig. Like you were on last week, Tony will, or his team, his minions, will drop some links about where people can find you to ask those questions about do I buy Apple or do I buy Intel? And you can answer all of those questions. So keep them coming, guys.
Neither. Thank you.